Welcome to the KnockOn Effect. This is where we start with a thing you know and end up in a strange place. I'm Justine Underhill, and joining us this week we have Alex Rosenberg.
Hello, how are you?
And we have the professor joining us from an undisclosed location, Roger Hurst.
Professor, how you doing?
I'm doing pretty well, thank you very much.
All right, very good. Hey!
Look who we have!
It's the professor
Hello,
in
everyone.
person.
Good morning, good afternoon, chaps. How are you?
right.
In
Good to see you.
the
Hello,
flesh
good to see you.
himself.
Indeed.
I guess I see the resemblance. I guess.
Not as official.
No, that's true. I'm Americanized today because I was in the
A little more
office.
photorealistic, though.
Yeah, yes, that's true.
And you join us all the way from the UK.
All the way from the UK, but I've got a special present with me today.
All right.
And it's not from the UK, so there's nothing coming from good old Blighty.
Oh.
But I've got a lovely plate
That's blinding.
of meat. A lovely plate of dried meat. Now, does anyone know what this is? Alex, come on, you must.
I mean, it's beef jerky?
Yeah.
Beef jerky, special type. Beef jerky is probably a North American version.
Ooh, it has a pungent
Smells
aroma.
like
Yes,
ketchup, I think.
yes,
Can I
it
smell?
does.
Yeah.
Now, which country is this normally from? It's got a special, well, a name for it. It's not a North American dish originally. What do you think it's from?
It smells like brisket or something, like beef brisket.
Interesting. I'm going to go Eastern Europe.
Eastern Europe. It's not bad. I mean, geographically a mile away, but they have this sort of stuff over there.
Turkey?
No, it's actually from South Africa. South Africa.
Okay.
Zimbabwe also.
Can I taste it?
Namibia, and I think Botswana. So it's that sort of the southern countries.
What type of animal is it?
It's beef normally. They can do venison. It's called biltong.
Very good.
So biltong is its name.
Biltong?
Biltong. Biltong. So it's dried, cured beef.
It's actually
or
delicious.
dried, cured antelope as well sometimes.
Ooh.
So very tasty stuff. So I thought I'd bring this on because biltong is getting cheaper.
Oh.
And biltong getting cheaper is good.
So you brought us a present from the discount bin. Look at this.
Exactly. It's only from the countries where yes, these things are coming much, much cheaper. And in fact, it becoming cheaper is really good for US large cap tech.
What?
Now,
So I guess that's the knock-on effect
that's
here.
the knock-on effect. Can you get from why cheaper biltong is good or should make people who like their large cap US tech even happier?
So maybe it's because all the Google employees are eating
biltong?
biltong. Yeah.
I don't know.
This is not really a West Coast type of thing, is it?
No, it's
No,
not.
it's very
oh,
much
you're right.
not.
Actually, not at all.
It would be like, air-dried kale or something like that.
Yeah.
Good stuff. So, would you like to hazard a guess as to why this stuff being cheaper is good for large cap US tech?
Do you want to try?
Well, fewer cows? No, I don't know. I got nothing.
I mean, my guess was the Google employees, but that clearly was wrong.
Yeah, we've up.
No, it's not that. So we'll go through a few things, and there are quite a few knock-on effects. But the first one is, it's from South Africa. So what's been happening in South Africa recently?
The Rand.
And the
Rand.
drought. Oh.
In the drought.
Oh, I don't know about the drought.
Oh, they've been warning about a
They had a massive problem with the water
lack of
table.
water.
Okay.
Yeah.
So which is it?
It's the Rand, not the drought.
Yes.
The drought was a few months back.
By the
Probably
way-
been good for curing.
Yeah, exactly.
So the Rand has basically been on the back foot. So it's kind of, we've been seeing this thing in EM overall, EM currencies, but when it's one country, is it two countries? Now suddenly we're seeing in South Africa, the Rand has been moving to just shy of its all-time low versus the dollar, which is 17 from a couple of years ago. It's currently around about the 15 level. And it's been moving quite dramatically. And this is another of these EM countries where there's been a bit of a problem. So the question here is, what's causing this? I mean, is it another idiosyncratic risk? Is it bad management in EM in South Africa? Or is it something more contagious?
And just to remind us, so it's been Turkey, Argentina. Does Venezuela count in this?
That's been just going terribly
quite.
wrong for a long time.
Okay.
I think we've got a little bit of a kind of Russia in there as well. But some of these people say, oh, that's a political risk and that's a political risk. And there are issues in South Africa, but is it political risk as well?
Yeah.
There are some issues there. But it's still moving, and it's moving quite dramatically. And it's one of maybe 4 or 5 now. So we can sort of have this kind of grouping of EM. You kind of think, well, okay, is it because of these individual countries, or is it something more sinister at work? And is it actually these countries that's the problem, or is there something else that's driving it?
And it could be both, right? It's like the Warren Buffett, when the tide comes in, you see you swimming naked sort of thing. So maybe it was just a very beneficial environment that all these authoritarian governments could say, well, it's because of us that things have been going so well, when really it's sort of what's going on around the globe. And then these strongmen are sort of coming into their test of strength.
And another thing is how we look at it. So are we looking at it compared to the dollar, or are we looking at it compared to other emerging market currencies?
The dollar is the key here. It seems to always come back to the dollar, but dollar is an absolutely important element of this. And we've seen it with these sort of countries, that the dollar is the real driver. But why are we seeing that now? Because, is the US strong? Yes, but the US was strong last year as well.
Mm-hmm. Yeah.
So why wasn't it happening last year? I mean, that was kind of the big thing, because everyone's saying, well, the global economy is doing well. And I think that's one of the key differences this year. What you're starting to see is the US doing incredibly well. I mean, the ISM, which is the survey, manufacturing survey, I think it's 61.3, hugely strong. And unemployment on Friday, 3.9.
Yeah, 3.9. And as President Trump tweeted, unemployment is below GDP for the first time in 100 years. Now, that's not accurate, but still.
No, it's a nice tweet.
Yeah.
Got to get them out there. And so you've got this environment
now.
No,
but I was being a little cheeky, but in all seriousness, that is, we haven't seen that lately. We haven't seen GDP grow and unemployment fall this low. So.
And a lot of this comes to this thing which people call the dollar smile. And the dollar is normally strong when the world is falling out of its own bottom, as it were. And the world isn't at the moment, just one or two countries. Or the dollar is strong when the US is much, much stronger than the rest of the world. And when the rest of the world is strong, that's when the dollar's weak. So we're in one of those, you get a smile, yeah.
So could you break that down actually a little bit more? So why is it that the dollar would be strong when the rest of the world is weak, and when the US is really strong?
So when the rest of the world is properly weak, and we're talking, when we've got a crisis on, then it's a flight to safety. Everyone kind of takes their money home. So that's one of the dollar strength stories.
So that would be like, I don't know, an Asian emerging market crisis or something like that.
Absolutely. If you saw the Asia dollar index in 1997, 98, it is one of the most phenomenal charts. It's just a complete collapse. And that's one side of the sort of the smile. So that's sort of the sad part of the happy smile, as it were. And then on the other side, you've got when the US is relatively strong, which it is today. And then you've got, the US is strong. Well, that's positive because you get the differentials coming in. And the bottom bit is where the dollar's weak, where if the whole world is doing well, all these high beta currencies, which are emerging markets, do really, really well. And for a long time, emerging markets were doing incredibly well on a relative basis. So they were able to write debts, do pretty much whatever they wanted to. And this kind of flow into their economies offset some of their issues.
And that's because people are looking for a good return.
Yeah.
Absolutely. And you weren't able to get so much of a return in the US.
That's exactly right. So you just had this money flowing out, going into the US, and maybe this was a bit of the QE money that was, where was it going to find a home? It was going out of the US into all these other opportunities. And so the dollar was basically underperforming in that period. But now we're seeing a little bit of a reversal, and we're seeing a reversal in QE. It's now gone to QT. The US economy is doing
quantitative tightening for those playing along at home.
Versus quantitative easing. So basically the US is now
if he's the professor, I'm like the teaching assistant.
Oh, okay, I like that. Cool.
That's right. And so we've now got money sort of being taken out, as it were, so this quantitative tightening. And so what you're starting to see is a lot of these emerging markets, which thrive when there's loads of dollars around, suddenly seeing dollars starting to become less frequent and less obvious in the global market. And also, I think that the tax change at the beginning of the year, where a lot of US corporates said, oh, I'll take my overseas dollars and bring them home. So there's less international dollars, this international market. So there's fewer dollars in the international marketplace at a time when also the US is looking relatively strong.
And that's because of the tax cuts.
Partly because of the tax cuts, partly because it becomes a little bit self-defeating. The tax cuts come along, the dollar goes up, and these emerging market economies, which relied on cheap dollars, suddenly find the dollars less cheap. And I think there's a statistic which is that in June, July, and August of this year, it's been the least issuance of emerging market debt since 2013. And 2013 was the taper tantrum. So this has been a bad summer for emerging markets. We know that, but it very much is there.
And now when you say cheaper dollars, that's a little confusing for people who are used to, the dollar is generally worth about 100 cents, right?
Yeah, so, exactly.
Just explain what you mean that they rely on cheaper dollars.
So they like cheaper dollars. So for instance, if the rand is exchanging at 12 rand to the dollar versus 15 where it is today, well, it took fewer rand to buy $1. So the dollar was cheap to someone in South Africa. Gotcha. And so that looked cheap. But now as the dollar's rallying and these emerging market currencies are weakening, effectively the dollar becomes more expensive to them. And so if you've got debts which are in dollars, external debts, which a lot of these countries have, the dollar now becomes a problem because you need more of your own currency to buy $1. And you've got these debts in dollars. So they go, oh my God, I need to cover this. I need to buy dollars.
Why were they borrowing in dollars in the first place?
Because the dollar market, and there wasn't just dollars, but dollars the easiest one because it's a liquid market, but also you had interest rates which are really, really low. So if you're issuing in dollars, you're effectively tapping into the low interest rates in the US. Now you could have done it in euros.
Or Japan.
But they're basket cases compared to the US. So euro is always one small problem away from catastrophe. Japan is always a catastrophe, even though it hasn't been. So the US is always seen as the best of a multiple bunch. And so the dollar is seen as being a relatively safe place to issue with low interest rates at the time and this global liquidity. So you can do vast amounts and not worry about this suddenly disappearing.
And also, people like to invest in dollar-denominated bonds too, right? Because if I'm country of Fredonia and I'm issuing Fredonian debt, I could issue it in the Fredonian, seashell. But that's an
interesting choice.
Currency of Fredonia. Gotcha. Same currency as Club Med, which is very convenient. So I could issue it in that, but then who knows? I could just inflate the value of seashells, and maybe Sally will find a lot by the seashore, and then all of a sudden your bonds you're not getting that much back.
Well, your metaphor just went.
Well, we know she collects seashells by the seashore. It's not a rumor. But meanwhile, and I could issue it in euros or yen, but there aren't as many euro and yen investors. Like people measure their performance often in US dollars, so they like to have a dollar
denominated debt.
Absolutely. I think it's something like 70% of global FX reserves are in dollar or dollar equivalents. So, it's just the lead currency and it has been for a long time. But that doesn't still say why that should be good for large cap US tech.
No.
All we just said is, emerging markets are having a hard time. And emerging markets, aren't they buyers of US tech? So in some ways, we should be saying, actually, it's bad. But no, in this instance,
right, because the worse the world does, the worse it is for Google.
Yeah, exactly. For
Alphabet,
anyone. Yeah.
Excuse me, Alphabet.
That's right.
It's so annoying, isn't it?
Absolutely. It's like, you think about these large cap, the S&P is basically, it's an exporting index, certainly the top end is. And so if they're seeing the dollar strengthen, then in some ways that should be bad for their sales. But there's another element at play here. We did touch on it, which was, is it that emerging markets are weak, or is it something to do with flow of funds? And it's the flow of funds which is what really matters here. And I think that's the drive. And can you see what that is, or can you guess what the flow of funds story is here?
So maybe more money. Oh, maybe it's something like investors are no longer, are scared of putting their money into South African rand, and so they're looking for places to invest. It's coming back home to the U.S. and because and it's going into indexes, and because tech companies are so heavily weighted in indexes, it's flooding into our alphabets of the world.
What she said.
It's very, very good. That's why she's here. Bingo. This is the thing is that, we've got this, and something that we've sort of seen is this equity rally. But when we talk about an equity rally, it's the US that's doing really well. And it's a smallish part. It's a large cap part, but it's actually in terms of number of stocks, it's a smallish part. But what's actually happening here is that what people forget is people look at the emerging markets and these dollar debts that they have. What they forget, though, is that in times of plenty, the US, which is still one of the main sources of global investment money, it leaves the US and it finds all these other pockets. And it goes into emerging markets, as you said, quite rightly, to make these extra returns. And as long as the dollar's stable and all the rest of it, people will park their money there. But if you've got, you're a fund with $100 million in South Africa, in South African rand assets, and the rand's now losing value, you're going, I'm losing money even if the equity market's going nowhere. I'm going to repatriate that money. And what's more, I can now get 2.6% in a US 2-year yield, which is a nice level compared to history in the last few years. So that money starts coming back, and that money's coming back into the US. And the first place it's going to go is somewhere liquid, which will be into bonds. What's happened to bond yields? They've gone nowhere. They've been at 3%, and everyone's going 4.5%, 1.5%. Right. That's been 3%, 3%, 2.8%, 3%. And the equity market, and it goes into the liquid equity market, which is the large cap tech. So actually what's happening in emerging markets, and the more this becomes a contagion for emerging markets, the more US investors will say, hey, I'm going to bring my money home. I'm going to stuff it into US assets. And so the US equity market's outperformance, and it is quite astonishing outperformance we're seeing compared to Europe, emerging markets, pretty much anywhere. It's probably this phenomenon of US is in the cycle where it's doing pretty well, and people just saying, well, why would I have my money in South Africa? Why would I have my money in Argentina? Put it in the US. The US is doing really well. Bring it home.
And that's a self-fulfilling cycle because then you have more money flowing into it, and then that boosts the stock prices.
Dollar going up, and the Fed. Are the Fed going to not tighten when you've got unemployment this low, ISM near the highs, over 60? I mean, it's an impressive.
And the market continuing to climb.
Yeah, and financial conditions. This is this sort of idea of we've talked about liquidity on here before, but financial conditions are very, very low, which means that the Fed, which uses that, will go, oh, you know what? I keep tightening, but the market keeps on saying, oh, no problem, I can handle it. I'll tighten more. I'll tighten more. Differential increases, dollar should go up more.
But then as the dollar strengthens, do you see that potentially slowing down the US economy so that it then becomes less attractive? So it's all kind of self-regulating in the end? I mean, I remember when the dollar was spiking up in 2014, and every single company, it was McDonald's or Boeing or whatever, they were saying, oh, our profits are down and earnings are down because of the strong dollar. Yeah. Everyone was blaming the dollar.
You had an earnings recession back in 2014, 2015 because of that dollar move. We haven't got through there yet. And I think this is one of the key elements of it, is that we've got dollar strength, but we're actually in the middle of the range. So we're not in any sort of dangerous level for the dollar. It's become dangerous for the emerging markets that since 2014-15 expanded their external dollar debts at the time when the dollar was on the back foot. And now the dollar's gone into a bit of a sort of a strengthening environment. That's where it's hurting them. I think for the US, it will become a problem. But then the Chinese recently said, you know what? We're not going to sit there and allow you to devalue the dollar again. We're not going to allow a Plaza Accord, which happened in the 1980s, and say, yeah, you know what? Dollar's now getting too strong, and we're going to. The Chinese are happy to watch their currency fall because their currency falling has offset the tariffs. So they've been actually like, well, it's a wash for us. Yeah. So the happy days there. But it brings in a couple of interesting things, which, there's this idea of an equity bull market, and I'd say that's a very US-centric view.
But stocks are going up, aren't they?
In the US.
Okay.
Whereas,
yeah.
So I mean, what is global macro? People say global macro, I'm a macro investor and equities are brilliant. It's like, well, what if I'm a European investor? What if I'm an emerging market investor? What if I invest in China and I can't invest much outside of China? Then actually you haven't got a bull market in equities. It's only in one area. And it's a phenomenal story in the US at the moment.
Okay.
Probably has more to run. But if I'm in Europe and I have to put 6% of my money in Europe.
But Europe never does well.
No, it's useless. It's a useless market, yeah.
But okay, so basically for us to say that there's a bull market is like also for us to say that you have an accent. Because it's a very US-centric view.
But he does have an accent.
And you do have a bull market.
Oh, okay.
So speaking of bulls, so you got us from the making of these bulls into biltong?
Biltong.
Into, what does that mean?
I think it's a South African phrase, although I'm not sure this is all South African biltong, is it?
No, this is actually, I believe, Brooklyn biltong. Brooklyn biltong. No, they're not giving us money, but so you got us there from the biltong. More emerging market trouble, better for the dollar. More things flow into the U.S. As the dollar continues to rise in a cyclical manner, good for large cap equity. But I guess what I'm wondering, is whether the good times for U.S. large cap tech is leading to the cheaper biltong or the other way around. Like, which way is the cycle really working? Because U.S. tech stocks doing well, it makes me as a U.S. manager, or even, I don't know, as a manager in Kenya, say, hey, I want to buy Alphabet, I want to buy Facebook, I'm going to get out of South Africa, and that's what leads to the tough environment, right? So which way?
So I think it is chicken and egg, obviously, and I think the real issue here has been that because the US has done well and these US companies have done well and the equity market has been going up because there's been good liquidity, it has allowed the Fed to do things which have actually revealed these fissures in emerging markets. So there's a whole combination of things, but if the equity market wasn't doing so well, it's unlikely that the ISM, which is these managers who pay themselves in shares through stock options, go, oh, it's great, the economy. They probably wouldn't have a very high ISM. But the ISM is high, so the mentality around the market is high, the unemployment rate is low. These companies are doing well. That sucks money in, which allows the Fed to continue to tighten, widening it out. So where did it start? Well, in some ways, you could say it started when the emerging market outperformance peaked, which was probably early part of this year, which then allowed the US to relatively outperform. If everybody's got the equivalent of an ISM or a PMI in the 60s, then actually the US probably wouldn't be so strong. The US is right up there, and emerging markets aren't. And I guess the question is always that, normally a strong dollar is bad, as we discussed just a few minutes ago, but we're in that phase where it's a strong dollar, but with a strong US. And the US is a bit of an island at the moment. It's a beacon of light. And I think it can continue to be relatively healthy. And that's going to mean these emerging markets continue to weaken. The question becomes, do the emerging markets weakening eventually follow through into weakness in the US?
If there's contagion.
Is that contagion that can come back to the US in any meaningful way? We saw in 1997 that it was Thailand, tiny little country, that really kicked things off. And is actually kind of something before that with the yen that's kind of led to it. But it was Thailand, and then we had the contagion. And a lot of that contagion was people withdrawing their capital. The money flows started to reverse. And that's potentially where we could go with this. But at the moment, if the US peaks and emerging markets, they had a little bit of an adjustment, but the US just peaks and slows a little bit, then actually get into the good bit of the smile again. The question is, do we go from the happy side of the smile to the risk-off side of the smile without ever getting in the middle, i.e., do emerging markets bring the US down? That's the unknown, and I wouldn't bet on that yet.
Optimistic-ish note to end on?
Well, depends where in the world you are.
Yeah.
Not so great for the biltong producer.
Yeah, I guess, but great for...
Although, this is the Brooklyn biltong producer. So
great for them.
Yeah.
And great for the US being a beacon of light, or perhaps maybe...
That's so nice of you.
Yeah,
Thank
thanks
you.
for
I got off a plane about an hour ago, so,
A little lightheaded still.
Yeah, still happy to be here. Give me a week.
Fine.
Well, it's great to have you in the flesh,
It's
Professor.
been an absolute pleasure to bring these foodstuffs on as well.
Great. Well, thanks so much for joining us for this week's KnockOn Effect. You can catch us every Thursday on realvision.com.
We also release a podcast version that can be found on your podcast app under Real Vision Presents. We'll get into a little more detail and find out where the professor's sick, sad obsession with biltong actually began. Get to really go deep Freudian psychological
the
on
meat
this one.
of the matter. No.
Yeah.
Anyway, and you can also sign up for your 14-day free trial on realvision.com/KnockOnEffect.
And let's let Roger give the pitch for the 14-day free trial. Why should people sign up?
Well, there's some fantastic stuff on there. If you want to know more about the dollar, there was Brent Johnson, his milkshake dollar theory.
Yes.
We've had some fantastic people covering EM in just the last week or two. Variant Perception came on. So there's some really good stuff around all of this that's been out in the last month or so. So get up to speed with it.
Oh, okay. Learn all about the dollar. All right, we'll see you guys next week. Now we can devour this.
I feel like with beer, this would be really good with beer.
It's very, very, very fucking salty.
Yeah.